We have a once-in-a-lifetime opportunity, and there is a set of stocks that are set to explode, and not for the reason that you might think. Let me show you a quick clip and explain exactly what I mean.
That just to get us to the point where we stabilize debt to GDP at where it is right now, here's what you need to do. You need to let the Trump tax cuts expire. That's $390 billion. You need to raise the payroll tax on every single working person, 1%. That's another big slug. You need to...
What do you think that does to jobs?
We're clearly going to have a period of contraction, which hopefully, that's why I was going to say, it's going to be really important for the Fed to be able to offset the fiscal contraction area that's going to come.
Then you want to increase the individual tax rate all the way to the top rate of close to 50%.
Now, hold it.
Yep.
I don't want to do any of this stuff. What I'm telling you is that we've got to be serious about where we are fiscally. And so I'm giving you, there's a whole set of options, right? We could go in and cut 25% of the federal workforce. Some people may do that. There's a website where you can go look and play with all the options. You can raise the capital gains rate from 21 to 28%. That only gets you $10 billion a year. It actually doesn't get you what you need. So I'm simply showing some of the things that you can do. Yes, you'd have to raise the tax rate on the top, I think probably everyone over 200 grand, probably have to raise that to 49.5%. If you do all these things, raise the Social Security from 65 to 70. If you do all these things, means test, Medicare, if you do all these things, all you do is you get to a primary balance. What that means is you stabilize debt to GDP. You're still actually increasing your debt.
Right.
You're still actually increasing it because it excludes the interest costs, which, oh, by the way, the interest bill this year is larger than every single line item except Social Security. It's larger than defense spending, larger than Medicare.
I want to talk about why you're here, which is Robinhood and this conference. But before I do that, is this, given all of the things you're saying, are you off buying gold and Bitcoin and hiding somewhere?
I think all roads lead to inflation. We're going to end up,
But does all roads lead to inflation?
Guys, we're listening to Paul Tudor Jones, and he's saying that all roads will lead to inflation. This is a pretty big issue in our economy, and I've made many videos now where I've pointed out that the government's lying to us with inflation. They're downplaying inflation, to be specific. Inflation's a lot higher than what we think, okay? They're downplaying it by manipulating the CPI basket, okay, the Consumer Purchasing Index, right? It's a basket of things that we're analyzing, right? So here, by the way, is the basket, the CPI index, okay? You can see right here that, they're saying that energy is actually getting cheaper. You see that food is actually going up a little bit, but not by much. And these, by the way, are the 12-month percentage change. The Consumer Price Index selects categories in September 2024. So this is actually a month ago or so, 2 months ago almost at this point, and not seasonally adjusted, okay? So CPI for all items rises 0.2% in September, shelter and food up. Now that's not a big deal in general, 0.2%, but it's a big deal because it's a lot higher than it actually is, okay? So I'm looking at some specifics here. So the average price data here is selected items you can see here. For example, let's go to bananas, okay? So bananas are, fairly stable. We can look at bread. So bread is kind of interesting here with the prices going up. Eggs are huge, right? Because of antibiotics use, and there's a whole lot of stuff with eggs, and eggs are a really big component. Eggs are a lot more volatile, and actually back here we had, I guess there was actually a disease for the chickens, so that's why the price of eggs for a large per dozen was like $4.82, right? So you can see a whole bunch of different things here. Oranges, pretty, not going up that much. Electricity. But the craziest thing is there is a weighting to the price index, and without spending too much time on this, looking at the nitty-gritty little charts here, I want to point out that right now is the most important time, especially in election month, right? Coming into election month, an election year, it's really important for us to be in the high-quality companies. I believe inflation will ramp up because they can't hide it forever. I do think that we're going to start to see more news of higher inflation. That's my personal take. And Paul Tudor Jones said the same. So I do have some tips for you. I want to finish off the clip though.
Inflation, therefore, gold is a good investment. Is Bitcoin a good investment to you?
I'm long gold. I'm long Bitcoin. I think commodities are so ridiculously underowned. So I'm long commodities. I think most young people find their inflation hedges via the NASDAQ. That's also been great. It's probably some combination. I probably have some basket of gold, Bitcoin, commodities, and NASDAQ, something like that. And I would own zero fixed income. If I had my cash, it'd be very short term. The playbook to get out of this, you see it in Japan right now. They have 2% inflation, 30 basis points overnight. They don't want to raise rates. The playbook to get out of this is that you inflate your way out, and you have a small tax on the consumer, and you run interest rates and nominal growth rate, interest rates below inflation and nominal growth above inflation. And that's how you reduce your debt to GDP. So you're going to have the Fed they should be easy. They should be
easy. You want them to cut.
So just real quickly, every 100 basis points, given where our debt to GDP right now, every 100 basis points is worth about $90 billion a year to the deficit. $90 billion. So yes, if we're trying to stabilize debt to GDP, we want to run the most dovish monetary policy that we can without letting inflation become too much of a tax on the citizenry. So yes, all roads lead to inflation. That's historically the way every civilization has gotten out, is they've inflated away their debt.
So guys, it does look like we're going to inflate our way out of debt, which is the most realistic and honestly the smartest thing the United States government can do. Is why would you pay off the debt with like really, really hard-earned money when you can kind of inflate your way out of the debt, right? And then that money isn't as meaningful, right? It's easier to pay back, and you know, money, it's kind of like it's like manipulation, right? It's paper. It's up, it's down. The currency can be, you know, more or less manipulated, and inflation can be manipulated. But what Paul Tudor Jones said right there, the man has so much experience. So I had to have you watch that clip, because I think a lot of things that he said is going to be a game changer, and it's going to make a big impact on the market. Now, one thing that I want to point out, the most important thing for me from that clip, an actionable insight, is he thinks that energy is underrepresented, which I agree with. In my portfolio, you know, we're doing very well. We're at $3.6 million. I'm on the road to $4 million, guys. I'm publicly showing everything. I'm personally also under on the energy, so I'm actually going to make a trade right now on XLE. Now, I don't have a whole lot of cash. Let me just check my cash real quick. Depending on how much, I have a lot of cash actually, just tied up in a lot of sell puts because I'm aggressively trying to get into positions. I'm running the wheel strategy, and I've sold a lot of aggressive puts, which is why you just saw I had $885,000 of cash, but my buying power is only 126K, and it's because, well, here's an SPY sell put I have. It's a very short-term put. I am doing a little bit shorter-term trading here and there on SPY, but anyways, I do have enough cash. I am going to purchase XLE. So look, I have a lot of my students, especially my one-on-one students, I've noticed that they have CVX, SLB, ExxonMobil. I like these three companies a lot, right? If you look at the top holdings here, you will see that ExxonMobil is 23% of XLE. It's a ETF with energy sector, right? They have ExxonMobil, they have Chevron, they have ConocoPhillips, Williams, and then here's the SLB. Here's Schlumberger, right? We got Phillips 66, we got Marathon Petroleum. I know a lot of you guys have Oxy, OXY. I think there was a lot of popularity. I think it was on YouTube, and there's just a lot of publicity on it because Warren Buffett's in OXY. You know, OXY is not a main contributor, or it's not a main holding right now in the top 10 for XLE. But look, I'm not against OXY. I think in general, energy companies are actually a really good investment. They have really good cash flow, really good really good cash flow, as well as good dividends. So if we take a look at the dividend income here, we got a 30-day yield of a little bit over 3%, okay? Now, it's up to you whether you go for single stocks or the ETF itself. I'll show you an example of both right now. I think that given what Paul Tudor Jones says, and given what I've been saying about inflation, when inflation goes up, which they're underrepresenting, I think when those numbers become more public, so to say, you'll see that commodity prices will also go up, and when commodity prices prices go up, these companies in energy will make more money. I do think part of that is priced in, I'll be honest with you, but I also think some of that is not priced in. So if you want a good hedge and a good protection in your portfolio, and Paul Tudor Jones said he doesn't have any bonds. Guys, I say the same thing. Why would you, even if you're in retirement, just go for option income. It's way more attractive than bonds. It's way safer. Options are safer than stocks. And in my opinion, options can be safer than bonds. Obviously, bonds are probably a bit more safer, but they also have no returns at all, right? So I'm not a huge fan of bonds either. So I agree with Paul Tudor Jones on all fronts there. Now look, if I were to do XLE, it's at $90 for the past 3 months. It's going sideways, which is actually a good thing. I would do a couple of things here, okay? You can run the covered strangle strategy, sell puts, covered calls, the wheel, right? The wheel, my bread and butter. These are my bread and butter. I actually just added covered strangle today in today's video, but my bread and butter is sell puts, covered calls, and the wheel strategy, all right? So I've been doing that for a decade now. So let's go into, I would just straight up keep it really boring. I would go through election, and I would just sell a put option on XLE. I would go right here around at the money. Okay, this is over a 3% return. If you want to generate income, the safest income, just go XLE. You get a sign, no problem. You have a strong cash flow. You have a strong cash flow ETF, okay? So I could go for something like this, sell this option right here, collect $300, put up $8,500. The return's not an awful lot. So here, if you want a higher return, what you can also do is you can also sell a call option. You could sell the 95. This gives you upside. This would be better if you want higher return. A little bit higher on the risk, I would say, a little bit higher, but not by much. You can do the 95 covered call, okay? So the 95 covered call here, essentially, you would buy 100 shares of XLE, and then you would sell the 95 call option. So when you sell the 95 call option here, you get upside from 90 to 95, which is about $5, and you get the $2. So you get $7 in total addressable or total potential upside on 90, which is, almost 10%. It's like a 7%-ish return. In 90 days, you get a 7% return. Now we're talking. Now that's good, okay? So it depends on which side you want to go on. Selling puts and covered calls are very similar in risk and return. So this is a very similar risk and return. But if XLE moves up, which I do think it'll move up, I would probably say the covered call. However, if you want to run the covered strangle strategy, you would do both. If you have a bigger portfolio, which is, majority of you guys and especially the one-on-one students I work with, got a 50K, 100K, 200K, 300K, etc., right? These guys are in closer to the retirement zone. But even if you're just a busy professional and you're just starting off in your option journey and you're at 25K, 50K, look, I think you can still do both, right? It is a significant portion of your portfolio and you have to be mindful of asset allocation and risk management. But what you can do is you can sell a 90 put option, and you can buy 100 shares and sell a covered call. Obviously, I only sell cash secured puts for the most part, unless it's more of my advanced strategies with one-on-one students that are, in the 6-figure range. So sell a cash secured put, you have to have the cash. And then for the covered call, you also want to have, you need to buy 100 shares because covered call by definition is covered. So you need to buy 100 shares. Now look, I think aside from XLE, what you can do is you can also sell, you can also go to individual stock itself. So ExxonMobil, I'll go over ExxonMobil and Oxy. Maybe I'll cover SLB as well. ExxonMobil has had a good performance. It is the leader and the biggest holding in XLE. So I think you can just go directly for Exxon. It's about the same price. Just go ahead and start off with the wheel strategy, sell a put at 120, go right at the money, go get the bull by its horns, all right, get the bull by its horns, bicep over tricep, okay, get the bull by its horns and go in there. I think it's going to be a good play, especially because energy prices, I think they're going to go up because of inflation being misrepresented, and Paul Tudor Jones said himself that he thinks that it's underrepresented. So I think there's an opportunity in energy, specifically for a safe, passive, consistent income approach to option selling on energy. So I'm taking a little unique twist here. I'm using my option expertise and my experience to basically apply it. I think the sector is undervalued, so this is a very good idea. Now, I will also look at Oxy. I know a lot of people have Oxy. Now, Oxy, I think, is a really interesting stock because year to date, the stock is actually down. So I knew that. I was doing the research on this stock, but it is at a good price point. It's at $51.90. I think if you're going to sell a put option, we've had a very hard bounce here at the $50 level, $49.91. So if you sell a $50 put, you are getting very good a strategic entry into Oxy, I would certainly look at Oxy as a single play. So it depends on your outlook. If you just want a simple income approach and you're one of my typical students, you know, engineer, doctor, dentist, you're a busy professional, just go XLE, just leave it alone. But if you have a little bit more time on your hands, you can go for some interesting plays on Oxy. Go for 50, for example. If I go to sell put, just go for 50, I can go for, let's say, November 15, you can go November 15, you can go December, you can go January. Guys, listen, the expiration date is just a time period, okay? You get paid in proportion to the time that you take, right? So you take a certain amount of time, you get paid. It's fine. You go 1 month, 2 months, 3 months, you go 3 weeks, 6 weeks. As long as you're under 90 days, there's some nuances there, okay? But for the purposes of this video, just to keep things simple, options really start to decay in that last period of time. As the period approaches to expiration, things get worse for the option, right? I can make an example, but I think you get the point. It doesn't matter too hard on the expiration. November 15th is fine. December traditional expiration is most important. Friday, third Friday of the month, traditional expiration, okay? So if you go for a 50 here, this is like a 2% return almost. It's about 2% return in 23 days. I mean, that's a very solid return. That's 4% a month, give or take. You know, we're at 3-4% a month. That's exactly what you need to do to compound your wealth to get into retirement. That looks beautiful to me. Oxy is a clear sell put. Now, the last thing that I want to quickly look at for energy is SLB. StupidRich, also very good price point. And this stock is going a little bit sideways. You know, in the past 3 months, it's down 14%. In the past 1 year, it's down. So I would say that this is a good opportunity to sell puts at 40 for, I would go November, December expiration, or covered calls at the 45 covered call. So, you know, I think Paul Tudor Jones is on point, and it's very on point with what I've been saying for over a month now, well over a month about inflation data coming in. So yeah, make sure that you're subscribed. I'm going to make more analysis videos to help you guys make more money. Let's be safe out there and take advantage of what the market gives us.